How do you double your money? We're going to show you how on this episode of Friends Talk Financial Planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois. John, people want to grow their money, and doubling it sounds great. I'd like to double my money. Why don't you tell me how?
What's the secret sauce? Well, first of all, I'm going to talk about a little tool to help think about that, and then we'll talk about how to double money. And the tool I want to talk about is called the Rule of 72. I was working with a client recently, and we're talking about, how much to their savings now, their 401k, what's it going to look like in 20 years in retirement? And a real quick sort of thumb in the wind way to look at that is this Rule of 72, which says when the earnings that you get, your return times the number of years equals 72, that's when your money doubles. And what that means is if you get 10% return each year, 10 times 7.2 is 72, right? So that means if you get 10% every 7.2 years, your money doubles. Conversely, if you get 7.2% return on your investments, that 7.2 times 10, so every 10 years your money doubles, right? So it's this little interplay, and you can say, well, geez, what do you think your returns are going to be? And then how many times does that go into 72? That's when your money doubles. So that's a really handy little tool to be able to estimate what future values might look like with what you've already done with your investing.
Yeah, and John, before the show, when we were talking about this, I grabbed my calculator because 72 rang a bell to me, and I realized that yes, 8 times 9 equals 72. So that matters for our calculation too, not keeping the multiplication tables in my brain. But that, again, a good rule helps us with these rules of thumb. So why don't you tell us about that?
Well, I just want to point out for the viewers that Bridget's a CPA and a CFP, like one of the smartest people I know. And it's like, okay, yeah, we've got these calculators. We don't need to keep stuff in our brain, right? It's not
Right.
about the math. It's about that tool of things. And
There's
so
no shame.
let me talk
No
about let me bring out one of those two legs in this little equation we're talking about is return, right? If you get 7.2%, I say 7 to 10% means your money doubles every 7 to 10 years, but you have to have it invested. If you've got that money in your bank account or your savings account and it's earning, most aren't earning even 1%, but if you get 1%, let's do our rule of 72. If I get 1%, 1 times 72 equals 72, right? That means it's 72 years for my money to double. If I just get 2% and maybe some CDs, it's 36 years to double. So you have to have it invested. So one of the big components about doubling your money is just having it invested and getting some return, not getting 30%, but getting some return, right?
Right. And not having everything in stocks because you need some stuff, there's some investments in safe investments, but having some in stocks, that's if you want to grow your money, that's what you need to do. That's why people invest in the stock market. People that don't need to grow their money, they've got enough.
That's right.
They invest in safe stuff. Yeah,
like when you've won the game. Then the other leg to that, right? So we have to get some return. It's not return doesn't drive anything. We don't need 36% return to double every 2 years, right? Just, the other thing is the time element. Right. And it is just like time really is the secret sauce to this, as far as I'm concerned, is letting it grow and giving it that time. And it doesn't have to be 50, it doesn't have to be 72 years or 30, right? But you get, decent returns. You get 7, 8, 9, 10%, and your money's doubling every 7, 8, 9, 10 years. And that's really significant, I think.
Right. So if we used an example of somebody who is 40 and has $100,000.
Yeah.
Okay. So if they are invested and they're getting 7 to 10% return, that means by the time they're 50, they should have $200,000. By the time they're 60, they should have $400,000. And by the time they're 70, they should have $800,000. So it's doubled every
right. It's double and then quadruple,
maybe more, depending. Yeah.
That's right. And it's just this time. It's this get rich slowly sort of thing that you hear some people talk about, right?
But then if we had that same person with $100,000 and they invested it, they could get 1% right now on their savings account. They would die without it Unless they live to be over
You think
110.
110, right? 112,
Yeah,
that'll double, right?
it still wouldn't have doubled.
Right. Right. So you've got to have those two factors in. And to
Mhm.
me, it's sort of like that time factor. It's sort of like built, baking bread or something. You put all the other ingredients and yeah, it's all
Yeah,
there, but that's like your one, and you sprinkle a little bit of yeast in there. And that's like the magic, right? And it doesn't
right.
happen instantly, but that's the stuff that makes it grow over time.
Yep.
So
Like one of my clients said, you put your money in your 401k and don't peak.
that's right.
And we peak once a year just to do a little adjusting, but that's it. Just let it go, let it grow.
So to wrap things up here, we've got the rule of 72, right? The number of years times interest, when that equals 72, your money doubles. You can do some
Times
projections.
times rate of
The
return,
rate of return.
not not
Yeah,
interest. Yeah,
it's not exactly, that's
yeah,
exactly right. Thanks for catching on that. So rate of return times years equals 72. That's the formula for projecting doubling. And you've got to have some investment to get that return. And it's time, right? That's the magic sauce to this.
exactly. So let's wrap it up. Again, I'm Bridget Sullivan Ramel, and this is John Shear, where Friends Talk Financial Planning. And if you subscribe, that would help us out a lot. So it helps us with YouTube, and it helps you get notified when we do new episodes.
And it helps other people find us if you find these things interesting. And speaking about finding people, both Bridget and I are members of the Alliance of Comprehensive Planners. So if you're interested in finding a planner that has the same approach to holistic and comprehensive financial planning, check out acplanners.org. There's advisors all over the country. So with that, we'll wrap up. Thanks, Bridget.
Thanks, John.